Welcome back to Smart Finance HQ. Today, we've got an incredibly important topic to discuss: inflation and its impact. If you've ever wondered how those rising prices at the grocery store or the gas pump are affecting your wallet, you're in the right place. In this video, we'll not only help you understand inflation but also show you the effects it has on your day-to-day life. Stick around to the end as we dive into real-world examples, some past instances, as well as equip you with strategies to beat inflation. So, don't go anywhere, because this video could be a game-changer for your financial future. Let's start by demystifying inflation. Inflation is the rate at which the general level of prices for goods and services rises, leading to a decrease in purchasing power. It's like a silent thief that erodes the value of your hard-earned money over time. But how does this affect your purchasing power? You can see these changes all across your day-to-day life. Imagine a world where a cup of coffee costs $2 today. But due to inflation, the same cup of coffee costs $2.20 a year from now. That's inflation decreasing your purchasing power. Your money has lost value because you can buy less with it. Secondly, it impacts your savings. Now, think about your savings account. If the interest you earn on your savings is less than the inflation rate, you're essentially losing money. For example, if your savings account is giving you an interest rate of 1% per year but the inflation rate is sitting at 3%, your money is basically losing 2% of its value every year. This is why it's crucial to understand the effect of inflation on your finances. Let's move from theory to the real world. I bet you're wondering if inflation is just a theoretical concept. Well, let's take a look at a few examples. 1. Zimbabwe's hyperinflation. In the late 2000s, Zimbabwe experienced hyperinflation. Prices were doubling every few hours, and a $1 trillion bill was barely enough to buy a loaf of bread. This extreme case shows just how devastating inflation can be. 2. Recent U.S. inflation. In recent years, the U.S. has seen an uptick in inflation, impacting the prices of everyday items. From gas to groceries, it's a vivid example of how inflation affects your wallet. We can see it impacts everything from cost of living to savings, often leading to difficult and economically uncertain times. To truly understand inflation's impact, we should also learn from the past. Inflation doesn't always have to be considered as a negative aspect. What happens when inflation is zero? Can it be too low or too high? What are its impacts then? Two of the most well-studied examples of inflation are the Great Depression and the 1970s oil crisis. During the Great Depression, the U.S. experienced deflation, which is the opposite of inflation and means that prices are falling. This had a significant impact on the economy. People were afraid to spend money, leading to lower prices, unemployment, and economic turmoil. The deflationary environment and economic contraction led to widespread unemployment and suffering. Many businesses closed, and millions of people lost their jobs, causing immense social and economic hardships. It shows that moderate inflation can be a sign of a healthy economy. Next up, we have a look at the 1970s oil crisis. In the 1970s, oil prices skyrocketed, leading to stagflation, a combination of high inflation and high unemployment. One of the primary causes of the 1970s stagflation was the oil price shocks. In 1973, the Organization of Petroleum Exporting Countries imposed an oil embargo, causing oil prices to skyrocket. This sudden increase in the price of a critical resource had a cascading effect on various sectors of the economy. The surging oil prices led to higher transportation costs and increased the cost of living. These price increases rippled throughout the economy, affecting the prices of goods and services. In response to rising living costs, workers demanded higher wages to keep up with inflation. Employers, in turn, raised prices to cover the increased labor costs. This wage price spiral became a self-reinforcing cycle, driving inflation further. It was a challenging period for the economy and a reminder of how external factors can impact inflation. Now that we have a basic understanding on what inflation is, let's explore how you can protect your investments and finances when inflation rears its head. Here are a few smart ways with which we can try and beat inflation. 1. Start investing early. The power of compounding can work in your favor. The sooner you start investing, the better your chances of outpacing inflation. 2. Invest in education. Education is your best weapon. Learn about financial markets, economics, and investment strategies. The more you know, the better equipped you are to navigate inflation. 3. Diversify and regularly review your portfolio. Diversification is your best friend. Invest in a mix of assets which we'll discuss ahead, like stocks, bonds, real estate, and commodities. When inflation hits one sector hard, your diversified portfolio will still provide a buffer. Keep a close eye on your investments and make adjustments as needed. What worked well during low inflation may not do the same during high inflation. 4. Invest in TIPS and I-bonds. Treasury inflation-protected securities, TIPS, and Series I savings bonds, I-bonds, are excellent options for inflation protection. TIPS, as we discussed earlier, adjust with inflation, ensuring your investment grows in line with rising prices. I-bonds, on the other hand, combine a fixed interest rate with an inflation-adjusted component. Both are safe, government-backed investments that can shield you from the impact of inflation. 5. Consider corporate bonds. While corporate bonds carry slightly more risk than government bonds, they can provide better returns. Look for corporate bonds with higher yields and solid credit ratings. These bonds often outpace inflation and offer a good balance between risk and reward. 6. Invest in high-dividend stocks. Stocks that pay high dividends can be another effective strategy. Companies that consistently pay dividends often increase their payouts to keep up with inflation. These stocks provide a source of regular income while offering potential for capital appreciation. 7. Explore real estate investment trusts or REITs. Real estate investment trusts are companies that own or finance income-producing real estate. They often provide dividends and capital appreciation, making them a great option for inflation protection. As property values and rental income rise with inflation, so do your potential returns. 8. Invest in commodity funds. Investing in commodity funds can be a direct play on rising prices. Commodities like oil, gold, and agricultural products often increase in value during inflationary periods. Consider exchange-traded funds, ETFs, or mutual funds that track these commodities. 9. Embrace gold and precious metals. Gold is often considered a classic hedge against inflation. It has maintained its value over centuries, making it a reliable store of wealth. Invest in physical gold, gold-backed ETFs, or mining stocks to add a layer of inflation protection to your portfolio. 10. Explore cryptocurrencies. For those seeking a more modern approach, cryptocurrencies like Bitcoin and Ethereum have gained attention as potential inflation hedges. While they come with higher volatility and risk, they have shown potential to outperform traditional assets during times of economic uncertainty. 11. Peer-to-peer lending. Peer-to-peer lending platforms allow you to lend money directly to individuals or small businesses. By earning interest on these loans, you can potentially outpace inflation while helping others in need. 12. Build a side business. Starting a side business or investing in income-generating hobbies can provide an additional income stream that keeps up with or outpaces inflation. It's a hands-on approach to protecting your finances. 13. Keep an emergency fund. Don't forget the basics. Maintaining an emergency fund in a high-yield savings account can help you cover unexpected expenses without dipping into your investments when inflation strikes. By incorporating these additional strategies into your financial plan, you can create a well-rounded defense against inflation. Each strategy has its own risk and reward profile, so consider your individual financial goals and risk tolerance when making investment decisions. In conclusion, while inflation is a constant economic factor, it doesn't have to be your financial downfall. With a combination of diversified investments, inflation-protected securities, and strategic choices like corporate bonds, high-dividend stocks, real estate, commodities, precious metals, and even cryptocurrencies, you can effectively beat inflation and secure your financial future. Remember, no single strategy is a silver bullet. It's the combination of these strategies tailored to your financial situation that will truly make a difference. So, take action, stay informed, and empower yourself to protect your hard-earned money. If you found this video insightful, please hit that like button and subscribe for more valuable financial insights. And, as always, feel free to share your thoughts and questions in the comments section. We're here to help. Until next time, stay financially savvy, stay informed, and keep building a strong defense against inflation. Your financial future is in your hands.